Hey there, America! Ever find yourself drowning in credit card bills? Well, guess what? The US government has bills too. Running a country costs a pretty penny. But unlike us, the government can't just rack up miles on a credit card. Enter Treasury bills, or T-bills for short. Think of them as IOUs from Uncle Sam himself. You lend the government some cash, they promise to pay you back with a little interest. It's like being the bank, but instead of a stuffy old building, it's the entire United States of America knocking on your door for a loan. T-bills are actually a pretty big deal, like the foundation of our whole financial system. We're talking trillions of dollars here, folks, sloshing around the economy like a tidal wave of cash. These little loans, these T-bills, keep the government afloat and help keep the whole financial system humming along. T-bills are the oil that keeps everything running smoothly. Without them, let's just say it wouldn't be pretty. But here's the thing about T-bills, they're not just for Wall Street hotshots. Regular folks like you and me can get in on the action too. And the best part? They're considered one of the safest investments out there. So, how do these magical T-bills actually work? Well, buckle up because we're about to dive into the nitty-gritty. First things first, T-bills are short-term investments. You lend your money to the government for a short period, usually less than a year. And just like your buddy promises to pay you back with interest, the government does the same with T-bills. They guarantee to return your original investment plus a little something extra for your troubles. It's a win-win. You get to play a part in keeping the country running and earn a little profit while you're at it. Alright, let's talk about what makes T-bills special, shall we? First off, they're like the comfy sweatpants of investments. Simple and easy to understand. With T-bills, what you see is what you get. You lend the government money, they pay you back with a little extra on top. No need to worry about deciphering complex financial statements or trying to predict the stock market's next move. T-bills are as straightforward as it gets. Think of them as the reliable friend in the investment world, always there for you, no drama, no fuss. And speaking of stability, did we mention that T-bills are considered one of the safest investments on the planet? That's because they're backed by the full faith and credit of the US government. Risk-free, you say? Backed by the full faith and credit. That's right, folks. Not even once in over 200 years. So when you invest in a T-bill, you can sleep soundly knowing your money is in good hands. It's like having your own personal security detail, but instead of burly dudes in suits, it's the entire US economy standing guard. But wait, there's more. T-bills aren't just safe and simple, they're also incredibly easy to buy and sell. You can snag yourself some T-bills through Treasury Direct, the government's online store for all things debt-related. Or, if you prefer the human touch, you can waltz into your local bank or broker, and they'll hook you up. And here's the best part. If you suddenly need your money back, no problem. T-bills are highly liquid, which means you can sell them quickly and easily in the secondary market. Liquidity, cashing out with ease. They're like the chameleons of the investment world, adapting to your needs, whatever they may be. So, we've covered safety, simplicity, and liquidity. But how do you actually make money with these T-bills? Well, it all comes down to something called a discount. When you buy a T-bill, you're actually buying it for less than its face value. When the T-bill matures, the government pays you back the full face value. The difference between what you paid and what you get back, that's your profit, my friend, and there you have it, folks. The ins and outs of T-bills, explained without the Wall Street jargon. The discount dance, buying low, redeeming high. What's not to love? So, next time you're feeling financially adventurous, why not consider adding some T-bills to your portfolio? You'll be in good company, alongside millions of other savvy investors who recognize the value of a safe and reliable investment. And remember, investing doesn't have to be complicated. With T-bills, it's as easy as lending a helping hand to the country and reaping the rewards of a secure and profitable investment. Now go forth and conquer the world of finance, one T-bill at a time. T-bill auction, a high-stakes game show. Alright folks, picture this, a giant auction house, buzzing with excitement. But instead of priceless paintings or vintage cars, we're talking about something even more valuable, T-bills, those little slices of the American debt pie. The US government doesn't just hand out T-bills willy-nilly, they hold auctions, like a high-stakes game show where the prize is a chance to lend money to Uncle Sam. These auctions are all done electronically, through a super secure government system. Think of it like eBay for T-bills, but instead of bidding on that vintage lava lamp, you're vying for the chance to invest in the US economy. And here's the best part, anyone can play. Whether you're a seasoned investor or just starting out, the T-bill auction is open to all. Non-competitive versus competitive bids, two flavors of T-bill shopping. Now there are two ways to play this auction game. Non-competitive and competitive bids. Non-competitive bids are like the express lane at the grocery store. Quick, easy, and no fuss. You tell the government how much you want to invest, up to a certain limit, and they guarantee you'll get your T-bills at the auction's determined interest rate. Competitive bids, on the other hand, are for the more adventurous investor. With a competitive bid, you specify the yield, or interest rate, you're willing to accept. If your bid is low enough, congratulations. You're the proud owner of some shiny new T-bills. But if your bid is too high, you might be out of luck. The key is to find that sweet spot, the perfect balance between risk and reward. Maturity. Mondays, picking your T-bill time frame. Now let's talk about maturity dates, shall we? T-bills come in a variety of flavors, from the quick and easy 4-week maturity to the more laid-back 52-week option. And just like pizza toppings, the choice is entirely up to you. Want to dip your toes into the T-bill pool without committing long-term? Go for a shorter maturity. Looking for a more stable investment to park your cash for a while? A longer maturity might be just what the financial doctor ordered. The point is, there's a T-bill maturity date out there for everyone, no matter your investment style or financial goals. The stop-out yield. Where the bidding stops, the interest pops. Now here's where things get really interesting. The stop-out yield. Imagine a game of limbo where the bar keeps getting lower and lower. That bar, my friends, is the interest rate. The government wants to pay the lowest rate possible, while investors like us want to earn the highest return. The stop-out yield is the lowest interest rate at which the government can sell all the T-bills offered at the auction. It's like finding that perfect limbo stance, low enough to win, but not so low that you faceplant on the dance floor. The stop-out yield is determined by the balance of supply and demand. Behind the curtain, the Federal Reserve's role. Now you might be wondering who's running this whole T-bill auction show anyway. Well, our good friends at the Federal Reserve, or the Fed for short, play a pretty big role. Think of them as the stage managers, the folks behind the curtain making sure everything runs smoothly. The Fed doesn't actually buy the T-bills themselves. Their job is to manage the money supply and interest rates in the economy. It's a delicate balancing act, but the Fed's expert juggling skills help keep the economy humming along. Auction day jitters. What happens after you bid? Okay, so you've navigated the ins and outs of the T-bill auction, placed your bids, and now you're anxiously awaiting the results. It's like waiting for the results of a baking competition. Did your financial cake rise to the occasion, or did it fall flat? Well, fret not, dear investor, because the moment of truth arrives the day after the auction. That's when the Treasury Department announces the winning bids and the all-important stop-out yield. If your bid was accepted, congratulations, you're now the proud owner of some US government debt. Just sit back, relax, and watch your investment grow, safe and sound in the hands of Uncle Sam. And if your bid wasn't accepted, don't despair. There's always next week's auction. Welcome to Treasury Direct, your one-stop shop for government debt. All right, folks, ready to dive into the exciting world of T-bill shopping? First stop, Treasury Direct, the government's very own online marketplace for all things debt-related. Think of it like Amazon, but instead of ordering that inflatable kayak you've been eyeing, you're investing in the US economy, one T-bill at a time. Now before you click away, thinking government websites are about as exciting as watching paint dry, hold on. Treasury Direct has undergone a major makeover, ditching the clunky interface for a sleek, user-friendly design. We're talking intuitive navigation, clear instructions, and a streamlined process that'll have you buying T-bills faster than you can say national debt. First things first, you'll need to create an account. Don't worry, it's easier than setting up a social media profile. Once you're logged in, it's time to start browsing. Treasury Direct offers a smorgasbord of investment options from T-bills to bonds to other government securities. The brokerage route, letting the professionals handle the paperwork. Now maybe navigating government websites isn't your cup of tea. Hey, we get it, sometimes you just want to leave it to the professionals. That's where our trusty friends, the brokers, come in. Think of them as your personal T-bill shoppers, navigating the ins and outs of the market so you don't have to. Most major brokerages, both online and brick and mortar, offer T-bills as part of their investment lineup. They handle all the nitty-gritty details, from placing orders to managing your account, leaving you free to focus on the important things in life, like deciding whether to splurge on that extra guacamole. Of course, this convenience comes at a price. Brokerages typically charge a small fee for their services, either a flat rate per transaction or a percentage of your investment. But hey, think of it as an investment in peace of mind, knowing that your T-bill purchases are in capable hands. Plus, with a brokerage, you'll have access to a wider range of resources and tools, like market analysis, investment advice, and even fancy charts and graphs that'll make you feel like a Wall Street whiz kid. So if you're looking for a hassle-free way to add T-bills to your portfolio, the brokerage route might be just the ticket. Secondhand T-bills, snagging deals in the secondary market. Now who doesn't love a good bargain? Well, in the world of T-bills, the secondary market is where the real deal hunters come to play. Think of it like a giant online thrift store for government debt where you can snag T-bills at discounted prices. You see, when someone buys a T-bill, they're not obligated to hold on to it until maturity. They can sell it to another investor in the secondary market, often at a discount if they need cash quickly or if interest rates have risen since they made their initial purchase. This creates an opportunity for savvy investors to swoop in and snag T-bills at a lower price, potentially boosting their returns. Of course, like any good bargain hunt, it requires a bit of research and patience. You'll need to shop around, compare prices, and be ready to pounce when you spot a deal that's too good to pass up. The secondary market for T-bills is incredibly liquid, meaning there are always buyers and sellers ready to make a deal. This makes it easy to buy and sell T-bills quickly and efficiently, giving you more flexibility over your investments. So if you're feeling adventurous and don't mind a little digging, the secondary market might be your T-bill treasure trove. Section 1. Money market funds, T-bills on autopilot. Now maybe you're thinking, this all sounds great, but I don't have the time or energy to be a T-bill tycoon. Hey, we hear you. Life's busy enough without adding government debt aficionado to your already overflowing plate. Well, fret not, dear investor, because there's a solution for that. Money market funds. Think of money market funds like the cruise ships of the investment world. You hop aboard, relax on deck, and let the professionals steer the ship towards a safe and steady return. Money market funds pool together money from multiple investors and invest in a diversified portfolio of short-term, low-risk securities, with T-bills often taking center stage. This diversification helps to minimize risk while still providing a decent return on your investment. Plus, money market funds are incredibly easy to manage. You can typically buy and sell shares directly through your brokerage account or even through some banks. They're also highly liquid, meaning you can access your money quickly and easily if needed. So, if you're looking for a set-it-and-forget-it investment approach, money market funds are like the autopilot button for your T-bill portfolio. And there you have it, folks. 4 different avenues to navigate the exciting world of T-bill purchasing. Whether you prefer the DIY approach of Treasury Direct, the guided tour of a brokerage, the thrill of the hunt in the secondary market, or the laid-back cruise of a money market fund, there's a T-bill investment strategy out there for everyone, no matter your risk tolerance or financial goals. Remember, investing doesn't have to be complicated. With T-bills, you can lend a helping hand to Uncle Sam while enjoying the peace of mind that comes with a safe, secure, and potentially profitable investment. So go forth, dear investor, and conquer the world of T-bills, one purchase at a time. Debt management, taming the national credit card bill. Alright folks, remember that massive credit card bill we talked about earlier? The one Uncle Sam racks up running the country? Well, T-bills are one of the key ways the government manages that debt, like a financial juggling act with trillions of dollars at stake. You see, every time the government spends more than it takes in through taxes, it has to borrow money to make up the difference. That's where T-bills come in. By selling these short-term debt instruments, the government taps into a vast pool of willing lenders, from individuals like you and me to giant institutional investors. Think of it like this: the government is throwing a giant party and we, the investors, are footing the bill by buying T-bills. But here's the good news. This isn't some shady backroom deal. It's a mutually beneficial arrangement where the government gets the funding it needs, and we get a safe and reliable investment. And just like any responsible party host, the government knows it has to pay its debts eventually. As T-bills mature, the government uses the money it receives from selling new T-bills to pay back the old ones like a well-oiled debt recycling machine. This constant flow of borrowing and repayment helps keep the government afloat and the economy humming along. Interest rate tango T-bills and the cost of borrowing. Now let's talk about interest rates, those magical numbers that determine how much it costs to borrow money, whether you're buying a house, starting a business, or just putting some expenses on your credit card. Well, guess what? T-bills play a starring role in this financial dance, influencing interest rates across the board. Remember the stop-out yield we talked about earlier? That limbo-like competition where investors vie for the lowest interest rate on T-bills? Well, that yield isn't just some arbitrary number, it ripples through the financial system, setting a benchmark for other interest rates. Think of T-bills as the head of the financial family, the one everyone looks up to and tries to emulate. When T-bill yields go up, other interest rates tend to follow suit, like a synchronized swimming routine of borrowing costs. And when T-bill yields go down, well, you guessed it, other interest rates usually follow their lead, making it cheaper to borrow money. This interconnectedness is why the Federal Reserve, our trusty economic guardians, keep a close eye on the T-bill market. By buying or selling T-bills, the Fed can influence the money supply and nudge those all-important interest rates in the desired direction, like a financial conductor leading the orchestra of borrowing costs. Market mood ring T-bills as economic indicators. Now, T-bills aren't just about debt management and interest rates, they're also like a giant mood ring for the economy, reflecting investor sentiment and providing clues about future economic performance. You see, investors are a savvy bunch, always on the lookout for safe havens for their money, especially during times of economic uncertainty. And what's safer than lending money to the US government, the entity with the AAA credit rating and a track record of always paying its debts? So, when the economy is looking shaky like a wobbly tightrope walker, investors tend to flock to the safety of T-bills, driving up demand and pushing down yields. This flight to quality, as it's called in the financial world, is a sign that investors are nervous about the future and are willing to accept lower returns in exchange for security. On the flip side, when the economy is booming like a 4th of July fireworks display, investors are more willing to take risks, pouring their money into stocks, corporate bonds, and other higher-yielding investments. This decreased demand for T-bills can lead to higher yields, reflecting the optimistic outlook for the economy. By analyzing T-bill yields and trading patterns, economists and investors can glean valuable insights into market sentiment, economic expectations, and potential risks on the horizon, like reading tea leaves but with a lot more data and a lot less mysticism. T-bill triumph, a foundation for financial stability. Treasury bills, those unassuming pieces of paper, play a starring role in the U.S. economy. From auction houses to money market funds, T-bills impact national debt, interest rates, and investor sentiment. They are the bedrock of financial stability, a safe haven from market volatility. T-bills ensure the government functions and provide a reliable avenue for investors. They represent the enduring strength and resilience of the American spirit. T-bills embody our collective trust in the government, so next time you hear Treasury bills, envision their vital role in our nation's economic well-being. They symbolize stability, security, and the unwavering American spirit. Maybe you'll be inspired to add T-bills to your financial portfolio.